Here's a company doing 47% revenue growth in the most recent quarter. A loan book growing 80% year over year with non-performing loans sitting at just 1.1%. A gaming segment printing 57% EBITDA margins. And the stock? Trading at $88 a share. This model says it's worth $244. Today, we're walking through every assumption, every segment, every number that gets us there. C Limited, ticker SE on the New York Stock Exchange, is a Singapore-based technology company that most people in North America have never heard of. That is precisely why it's interesting. 3 completely distinct businesses under one holding company, each one valued differently, each one pulling the stock in a different direction. Shopee. Shopee is the dominant e-commerce marketplace across Southeast Asia. That's 7 countries, 700 million people, and it's gaining ground fast in Brazil. In 2025, Shopee processed $125 billion in gross merchandise revenue. That's not a typo. And the margin story is just as important. 2 years ago, the segment was losing money. In 2025, it produces $881 million of adjusted EBITDA. That inflection is the foundation of the entire bull thesis. Money is where this gets interesting. Formerly C-Money, it's a digital bank. Consumer loans, digital deposit accounts, buy now, pay later embedded inside the Shopee checkout. Banking licenses across Indonesia, Thailand, Vietnam, and the Philippines. The loan book hit $9.2 billion at year-end 2025 and was growing at 80% year over year. Non-performing loans, 1.1%. By every single metric that matters, growth rate, credit quality, market penetration, this is a fintech company, but the market is pricing it like it's an e-commerce sidekick. That mismatch is the most important analytical point in this entire video. We'll come back to it on the next slide. Garena. So the gaming division, publisher of Free Fire, one of the most played mobile games on the planet, with over 600 million quarterly active users. The comeback here is real. Bookings grew 37% in 2025 to $2.9 billion. Paying user ratio expanding, 57% EBITDA margins. The segment alone is printing more cash than most companies you've ever heard of. Now, the reason we build a sum of the parts model rather than valuing C as a single blended business is exactly this. These are 3 segments that have nothing to do with each other operationally. Different risk profiles, different growth trajectories, different appropriate discount rates. Blend them into a DCF would be like averaging a bank, a marketplace, and a gaming studio, and calling that a valuation. So it isn't. So we won't. I want to stay on money for a full minute because this is where the real mispricing lives. What the market sees. C Limited is classified by indices, by ETF allocations, by analyst coverage desks as an e-commerce company. That means Money's $1 billion of EBITDA is being valued on an e-commerce multiple, not a fintech multiple, not a digital banking multiple, an e-commerce multiple. This is the gap we're exploiting in this model. What money actually is. It's a digital consumer lender with banking licenses across 4 Southeast Asia countries, growing its loan book at 71% year over year while maintaining NPLs below 1.1%. That is not an e-commerce metric. That is a best-in-class fintech credit metric. The kind of number that, if it appeared on a standalone company's balance sheet, would have fintech analysts falling over themselves. The comparable, we use Nubank, the Brazilian digital bank that the market loves, trades at 6 to 8 times revenue. Comparable growth profile, higher NPLs than Money's FY25 revenue was $3.8 billion and growing at 60%. If Money were listed as a standalone company on a US exchange tomorrow, it would not trade at an e-commerce multiple. It would trade at a fintech multiple, and that re-rating alone would add $50 to $70 per share above our base case. Why it hasn't re-rated yet? The market won't pay a fintech multiple until Money proves credit quality holds through a full loan cycle at scale. The book was $5.1 billion 2 years ago. It's $9.2 billion now. It will probably be $15 billion in 2 years. The question the market is asking is, can you maintain 1.1% NPLs through a full credit cycle at this scale? That answer doesn't exist yet. When it does, that's when Money gets its fintech multiple. That's when C re-rates. Here's how the model works. For each segment, we build a 5-year discounted cash flow model, projecting revenue, EBITDA margins, CapEx, and working capital, then discount everything back to today using a segment-specific cost of capital. Shopee gets 11.5% WACC, that's weighted average cost of capital, reflecting the execution risk of emerging market e-commerce and a profitability track record that's still short. Money gets 13% because lending businesses carry credit cycle risk that demands a premium. Garena gets 10.5%, the most mature cash generator of the three. At the end of year 5, we add terminal value using conservative long-term growth rates. Our 4.5% and 2% respectively. These are not aggressive. They are, if anything, cautious. Now, here's where it all comes together. The Shopee segment enterprise value, $55.9 billion. Money segment enterprise value, $52.9 billion. Garena segment enterprise value, $29.6 billion. Total segment enterprise value, $138 billion. Now we bridge from enterprise value to equity value per share. We add C's net cash, $7.2 billion after netting debt against the $10.2 billion on the balance sheet. Subtract minority interests minus negotiable, divide by 595 million shares. Intrinsic value per share, $244. Current price, $88. Implied upside, or 178%. Now, let me give a disclaimer. While a sum of the parts valuation can reveal hidden value, it can also be faulty because it assumes the whole is equal to the sum of its actual parts, ignoring the reality that the market typically applies a conglomerate discount to diversified companies. This model can lead to an inflated intrinsic value by overlooking the massive tax liabilities and transaction costs triggered by actual divestitures, failing to account for shared corporate overhead that drags down the individual segment margins, and relying on biased peer multiples that may not reflect the specific risks of the parent company. Without a concrete catalyst like a spinoff and sum of the parts, valuation remains a theoretical exercise that can trap investors in stocks that look cheap on paper, but remain stagnant due to the structural inefficiencies and lack of transparency. So, look, this is why I also ran a discounted cash flow model, which is one of the primary metrics that Wall Street uses. I used a 10% weighted average cost of capital and a 3% terminal growth rate. With these conservative assumptions, the projected per share price estimated at still a whopping $131.33. That's still a 32.8% margin of safety. And honestly, this is a much more conservative model for this company. And I believe it's going to be successful. And quite honestly, I think it will be more successful than this lower end range. But I'm not 100% confident that it's going to get to the mid 200s soon. Every model is only as good as its assumptions. The 244 number, it's not just a prediction. It's a framework, a structured way of thinking about what this business is worth under a specific set of conditions. Let's stress test it. Bull case. The bull case simply money getting its fintech multiple. If the loan book scales past 15 billion with NPLs still below 1.5%, the market can no longer deny the credit quality story. A re-rating to new bank comparable multiples for money alone adds $50 to $70 per share on top of the base case. Combine that with Shopee margins reaching 13%, still well below Mercado Libre's peak, and a WACC compression that, as the business matures, intrinsic value north of 350, potentially. That's under essentially perfect conditions. The base case, what we've modeled, assumes management executes on guidance, money NPLs hold below 1.5%, Garena stabilizes around Free Fire, and Shopee margins grind to 11% over 5 years. No heroic assumptions, no multiple expansion, just the math on what the business produces in free cash flow. And the bear case. Here's what kills the thesis. Money's NPL ratio spikes. This is the single most important number in the entire C thesis. Provisions for credit losses or losses grew 77% in 2025 on 60% revenue growth. That spread needs to be watched every single quarter. If the loan book grows fast and underwriting standards slip, even slightly, provisions blow up the income statement. Garena fades faster than modeled. Free Fire is 12 years old. Mobile gaming is unforgiving. If the next title doesn't land, 29 billion, that 29 billion segment could compress. And Regulatory risk. 6 jurisdictions, any adverse licensing decision in any major market is a asymmetric risk no model can fully capture. Even in a bear scenario, WACC 3% above base, terminal growth 1% below base. Simultaneously, the model still produces a value close to current price. The downside is bounded, the upside's not. That's the asymmetry. This is important, so listen up. Yet again, I need to shout out CDN Ricky Bobby, one of the most dialed in members of the ALSTOCKTRADES community. This video is only hitting YouTube because he wanted to collaborate with me. And let me tell you, he puts in some dangerously solid work. To follow him, check the link in my description down below. I'm leaving his X handle in there. Go follow him to gather the alpha that he's been providing. And if you're watching this as an outsider of the ALSTOCKTRADES community, this is exactly what we do. We pull the filings, we use the tools, we understand the thesis, we collaborate, learn, and grow. We understand why the number is what it is, because when you understand the math, you stop reacting to the noise and you start seeing the opportunity before the market does. This is one in many examples of pure alpha produced inside of the lifetime access terminal. Now, here's the deal. This is not financial advice. We're not chasing this stock at 88 just because the model says it's undervalued. Valuation gap is not a catalyst. The market knows C exists. Someone today owns the shares you may own tomorrow. The discount is there for reasons. What we're watching for, the 3 triggers that signal a re-rating has begun. 1, money NPL holds below 1.5% as the loan book crosses 15 billion. That is the proof the fintech thesis is real. 2, choppy EBITDA margins print above 7% on a sustained basis. That proves the unit economics are structural, not a one-quarter anomaly. 3, any formal expansion of the capital return policy, a larger buyback or a dividend that signals management's conviction that the stock is cheap and the business is self-funding. When those dominoes fall, we will be back, segment by segment, modeled, updated, assumptions checked against fresh data. That is how you build conviction over time. C Limited, 3 businesses, 1 price, $145 billion of intrinsic value sitting behind an $80 stock. And inside it, a digital bank that the market hasn't fully found yet. Hit the like, drop a comment. What segment do you think is the most mispriced? And subscribe so you don't miss the follow-up when C starts to re-rate. See you in the next one. Before you go, if you want to institutionalize your research process, consider securing lifetime access to ALSTOCKTRADES. Founded by Dr. Albert Allen, the platform gives you permanent, uninterrupted access to over 60 advanced analytical tools and more than 40 years of historical data, all without any necessary recurring subscription fees. To lock in this long-term value, click the link in my description down below. Use code DRAGON at checkout and take a massive $2,300 off your lifetime membership. Replace market speculation with objective, data-driven conviction today. I'll see you in the next video.